Okay, I'll walk through a handful of exercises here for Chapter 6 of Cost Accounting, where we are product costing. So here we have a company that manufactures a special fluid, and they give us materials, labor, and manufacturing overhead for the month of June. They tell us that they have produced 1,250,000 liters in June. Let me grab my calculator here real quick. Okay. And they did not have beginning or ending inventory. So compute the cost per liter of liquid. So you would want to take all three of your costs and add those together. So I guess they've done that down here below for us. So your materials plus your labor plus your overhead, that gives us 3,580,000, and then divide it by your total liters produced. So that will give us our cost per liter. Okay, then now we have their retail store offering a variety of products. They offer free returns. Their returns are processed at a special facility near one of the air freight hubs. The return processing facility checks the returns documentation and the condition and determines the disposition, either return to stock, sell it as a used, or trash it. So the system is designed so that all returns start the process on a given day or processed that day. So they processed 38,050 returns with a dollar sales value of $3,785,000. The costs incurred are listed below, so the facility's labor and the facility overhead. So compute the cost per return for the month of May. So again, we're going to come down, look down here below. We're going to add the facility labor and the facility overhead, and then just divide it by the number of returns that were processed. So the cost per return is going to be $4.01. Now then the second thing says compute the cost per dollar sales volume for the returns. So then in that case, we are going to take our total costs incurred for those returns and then divide them by the sales dollars. So the 3,785,000. So that would give us 4 cents is the cost of that return facility per dollar of sales returns. Okay, then we have Bostwick Chemicals, started business April 1st. They have the following operations data. So we've got beginning inventory of nothing. They've started in April 362,000, of which 46,000 are left in their ending inventory, and they are 75% complete. So we're going to want to calculate the equivalent units of those 46,000 that are 75% complete. And then they give us the costs incurred, materials, labor, and overhead. There are never any finished goods because it is production to order, so they don't maintain any inventory. So compute the cost of goods sold for April. So as we come down and look down here below, like I said, we want to calculate the equivalent units of the 46,000 that are left in our ending inventory. So 46,000 times that 75% gives us the 34,500. If we had a total of 362,000 started, 46,000 are left in our ending inventory, then the difference is sold. So that's how that 316,000 is calculated. So 362 minus the 46. So then now we'll add up our total costs. So the materials, the labor, and the overhead to get to our total cost incurred. And then we're going to take that total cost incurred, and then we are going to divide that by our equivalent units. So down here, B, if this little B, they're taking the total cost incurred, divided by our equivalent units, which again is the 316,000 plus the 34,500. And then that gives us $3.90 per unit. And then we're going to multiply that times the 316,000 units that were sold. So then what remains in our ending inventory is the equivalent 34,500 units at $3.90. Okay, then our process costing, we have no work in process inventory. It starts 94,000 gallons of lubricant and completes 56,400. They give us the materials and the conversion costs. The conversion costs include our labor and our overhead. They estimate that that ending inventory is 40% complete. So again, we're going to have to do kind of the same thing we just did. We have 94,000 gallons that started into production. 56,100 are completed, so that would leave 37,600 in our ending inventory, and then it tells us those are 40% complete. So that's the 15,040 when we come down here to calculate those equivalent units. Then add those together to get to 71,440. Then we're going to come down and take our total, our conversion costs and our material costs, add those together, and then divide those by the 71,440. So again, if I keep going down, that's this little b. So the total cost added together divided by the equivalent units gives us at $5.80. And then we're going to multiply that by the 56,400 that was transferred to finished goods inventory. And then we're going to value the remaining equivalent units in our ending work in process inventory. And then calculating our predetermined overhead rate to allocate out that overhead. They give us our units produced, our machine hours, our direct labor hours, direct material costs, direct labor costs. It's the manufacturing overhead that we're trying to allocate. So compute the predetermined overhead rate, assuming that they are using machine hours. So we're going to take all of our costs, if I come down here, and then we're going to divide it by the machine hours, the 28,800 total machine hours, and that will give us a rate per machine hour. So hopefully that's pretty easy. And then sometimes, again, like we said, we can allocate it based on two things. If we have two different activity drivers, we may choose two different ways to allocate those costs. So in this case, we've got two packages, Tourist and Premier, and they have a call center. They track the calls. So we've got our number of calls, our minutes of calls. We've got our call center costs that are call related, and then we have call center costs that are call minute related. So we're going to use that two-stage allocation. So compute the call related overhead. So we're going to take our call related costs of 200,000 and we're going to divide those by our number of calls, divided by the 32,000. So if I come down here, you can see 200,000 divided by the 32,000 gives us that $6.25 per call. Then we'll do the same thing for the call minute related. So we'll take our 121,500 and divide that by our total number of call minutes. So that is going to be the 270 if we add those two together. So then that gives us 45 cents per call minute. And then we're going to allocate those out based on how much each used. So our number of calls for the Tourist, we would take our 20,000 times the $6.25, and that would give us our call related. So I think it does it for us down here, right? So the $6.25 by the times the 20,000 gives us our call related costs. Then we take the call related minutes, or the call minute related, the number of minutes for the tourist is 108,000 times the 45 cents. So again, come down here, look at B, 45 cents times 108 minutes gives us 48,600. So we'll add those two together. Sorry, and that's the call that's going to get charged to the tourist. And then we do the same thing for the premier. So 12,000 times the $6.25, that gives us 75,000. And then our call minutes of 162,000 times the 45 cents, and that gives us 72,900. And then we would add those two together to get to what we're charging to our premier. So hopefully that all seems pretty basic in how we allocate. Just always read those careful.